Welcome to the Mortgage Rate Weekly Market Update for the week of March 6, 2017. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you your update. Well, last week was not a good week for mortgage rates. If you take a look at the bond chart on the screen, you can see mortgage bonds did sell off last week, move mortgage interest rates higher. Last week on Monday, we did recommend locking because, as you can see, the previous Friday with that green candle, we hit a ceiling of resistance, and we hit that the previous week, the previous time we sold off. And the time before that, again, we hit that same ceiling of resistance and then sold off. So we made the right call. We said we're probably going to sell off here as a tough ceiling of resistance. That did happen. And then if you look at the chart on Friday, we did hit a floor of support, which was the previous floor of support the last two times. We hit that, had a green candle on Friday. We were able to rally off of the support. So with that in mind, being at the bottom of the trading channel, we're going to recommend floating your mortgage rate to start the week to see if mortgage bonds can make a run at that same ceiling resistance again and move interest rates slightly lower. So go ahead, float your interest rate, see if mortgage bonds can rally from here and move interest rates lower. Now, if we dig into the news, the GDP report came out last week in economic news. It came out the second reading for the second of three readings for the fourth quarter of 2016 came at 1.9%, below expectations of 2.1%. Now remember, GDP is a measure of goods and services produced by a nation's economy and considered the best, broadest measure of a nation's economy. Now, expectations for 2017 GDP are between 2.25% and 2.5%. Now, the increase in expectations, the main reason for that is tax and regulatory reforms that people are thinking are going through with the new administration. So if that doesn't happen, we won't see a rise in GDP because we won't see a rise in business spending. Then we saw the federal chairwoman Janet Yellen give a speech last week, which moved the market. Basically, if you listen to her speech, pretty much hinting that their March 15th meeting, they're going to raise the Fed funds rate again. In the short term, that could have a bad effect on mortgage interest rates. Long term, a couple days after that, we could see mortgage bonds rebound like they did in December and then move lower. So we'll keep you updated on as we get closer to the March 15th meeting. Then we saw weekly initial jobless claims come out on Thursday. Dropped 19,000 down to 223,000 claims for the week. That's the lowest since March 1973. The 4-week moving average also moved lower to 234,250 claims, which is the lowest since April 1973. So weekly initial jobless claims, very strong, showing a very resilient labor market. We get the jobs report coming out this Friday. We think it's going to be a very good report. That could be bad news for bonds. We'll see, and we'll let you know on Thursday, so look for a possible lock alert as we go into Friday's jobs report. Now, in housing news, we had pending home sales for January 2017 released. Came out at a disappointing 2.8% drop, which was below expectations of a 0.9% positive. Now, remember, pending home sales measures the number of existing home sale contracts that were taken on a property. And December 2016 pending home sales were also revised lower from 1.9 to 0.8%. So not a great start to the year because pending home sales turn into existing home sales. But there is a silver lining in that report. The drop in pending home sales is because we have such a low inventory. Low inventory means there's not enough homes to put under contract, so pending home sales are dropping. We have a lot of demand. Buyers want to buy. We just don't have a lot of homes on the market. The supply of inventory is at record lows. So that's going to support higher home prices. That's going to put upward pressure on home prices. So it's a great time to buy. If you're buying in Delaware or Maryland, you're looking at about a 3.5% price appreciation this year. Over the next 5 years, that's going to equate to, they're predicting about a 17% price appreciation if you buy now and hold it for 5 years. So that's a great investment for you. So it's a great time to get out there and buy. And then we saw home prices measured by the S&P Case-Shiller 20-City Home Price Index. For December, it was up 5.6%. That's a move of 0.3% up from November of 5.2%. Now, the national Case-Shiller Home Price Index show home prices moved from 5.6 to 5.8%. So home price appreciation moving up. Definitely going to keep moving up with this low inventory environment. So it's a great time to buy real estate. Now, if we look in the local market, the 1 year year-over-year price appreciation, Delaware was 3.51%, Maryland 3.24%, New Jersey 3.39%, and Pennsylvania 3.01%. So that gives you some price point appreciation in the local market. Now, in local news, we got the next first-time homebuyer seminar is Saturday, March 18th in Newark, Delaware at the Christiana Hilton Hotel. That's from 10 a.m. to noon. And then the next one in Dover is Saturday, March 25th. That's from 10 a.m. to noon at the Dover Holiday Inn right there on Route 13. Now, you can register for either one of those events by giving us a call in the office at 302-703-0727, or you can register online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.